Hi, guys. Let me tell my Instagram that I'm live. Story create. Hi. Welcome to the live. If you are here, please like the live. I'm going to give it a couple of minutes for people to join the live before I get started. Can you see my screen if you're here? I'm sharing my screen. I'm not sure if you guys can see it though. So if you are here, could you just let me know if you can see my screen? Next. All right, let me go look at my own YouTube channel and see how it looks. All right, let me go look at my own YouTube channel and see how it looks. Okay, no, you don't see my screen. Thank you so much for letting me know. Maybe I gotta choose one of these layout options. No, you don't see my screen. Thank you so much for letting me know. Maybe I gotta choose one of these layout options. Hi, Crystal. Hi, Crystal. Chrome has lost permission. Follow these steps. Oh, great. Hi, Crystal. System. Chrome has lost permission. On your Mac, click the Apple logo on the top left. Pardon this brief interruption. I'm trying to figure out how to share my screen. I never did this before. I usually do like YouTube Zoom sessions, but I think I have to go here and then go to privacy settings. And then I need to go to I don't see Chrome. Okay, let me see what they say. 1 second, guys. Privacy, click screen recording. Give it to Chrome. Screen recording. Check the box next to your browser. Allow these apps. It's not allowing me to let Chrome see my screen. Click the lock icon to make changes. Oh. Well, at least I know my computer's secure because they are not playing around. Not the right password. Oh. Okay, give Chrome permission. Sorry, guys. I had to quit the application in order to get it to work. So I'm going to go back and try to share my screen. I should have did a test run. I thought this was easy and you just like share your screen like with Zoom, but apparently not. It's not how it works. So let me go back to StreamYard. Okay, not your screen. Okay, so I'm going to try this one more time and let's see. Share screen, monitor one, share. Yay! It's sharing now because I see myself. All right, so let me put you in present mode. All right, now you guys can see my screen, right? All right. So thank you guys to everybody who decided to join the live. Hi, Crystal. Hi, Mom of Three, Mike T97, and to everybody else who decided to join. I'm here to learn. Yes, you can see my screen. Yes, I'm here to just talk about home ownership. So one of the reasons why this came to my mind is something that was, something we should be talking about, particularly because in our community, not a lot of people talk about what it's like to buy a home, what the process is to buy a home, what are the steps to purchasing a home. I know for myself, my mom bought her own home, but she bought it later on in life. And so we was kind of just learning as we go, right? But I think if I have information that I think can help the younger community, then I definitely want to be the person to share it. My nephew most recently has decided to talk about potential home ownership process. He came to me and he's like, Auntie Mira, mind you, he's like 25 years old. He's like, Auntie Mira, I want to think about buying a home. What are the steps to doing so? And he was like, a lot of people don't know about the home buying process. So I think it's something that you should talk about on your channel. And I'm like, you know what? That's a really good idea. So I put together a little presentation that's going to kind of walk you guys through the fundamentals of purchasing a home. If you guys have any questions, please put them in the chat. And then as I get about 50% through the presentation, or actually 30%. When I get about 30% through the presentation, I'll scroll up and answer some questions, and then I'll move forward. I don't want to answer questions while I'm doing it, because when you do that, you start losing track of your thought and what you were supposed to be talking about. So before we get started, if you could just try to reserve, if I don't respond to you, reserve your question. If you have something that you absolutely want to know, you could put it in the chat now, because that way, if I don't cover it in the presentation, when I get to the section that it pertains to, hey T, how are you? When I get to the section it pertains to, I will make sure to include your question. So I'll give you guys about 60 seconds, because I know there's a delay with the StreamYard. If you have a question that you want to make sure I absolutely cover in this presentation, drop it in the chat right now. That way, when I get to that section, I'll cover it. So in the meantime, I hope you guys got some water. Do I have water? I don't have water. I need water. I'm going to run in my room and grab some water. In the meantime, y'all write y'all questions if y'all have any before I start. Okay, I'm back. And also share the stream with a friend. If you guys know anybody in your life right now who's thinking about buying a home, Biden is in talks about passing some first-time home buyer benefits, offering a tax credit. It hasn't been finalized yet, but it is a big topic of conversation in Congress. And if it does get passed, this is something I think is going to benefit especially people who are in low to moderate income areas. What is low to moderate income? Great question. I'm going to tell you now. Usually it's thought of as being no more than 1.5 times your median area income. So if you live in a place and the area income is $30,000, if you're curious about your median area income, you can just go to Google and type in median income level for New Jersey or Boston or Minnesota or whatever town you live in. It'll tell you your median income. You're going to take that number and multiply by 1.5. If you make less than below that number, you are probably going to qualify for some of these first-time homebuyer programs that are potentially going to be dropped by Biden and his administrative team. And this information is going to be crucial when it comes to that process. Now, if you do not qualify, don't worry. There are some additional programs available to you, one of which I'm going to highlight in my presentation today, which is going to be great. What is the first thing you should do before hiring a real estate agent? Yes, I'm going to talk about that in the presentation. So that is a great question. So we're going to talk about that in the presentation as well. And now I will go ahead and get into it. So let's go. Oh, wait, where do I click to get into advanced? Oh, there we go. All right. So how to prepare for home ownership. The first thing you want to do when you're thinking about preparing for home ownership is check your credit profile. That is absolutely 100% the first step. Why? Because home loans are based on your debt to income ratio. That is the metric that they are looking at to determine whether or not they are going to give you this loan. What is a debt to income ratio? A debt to income ratio is look at the income you make. I think I talk about it on one of these slides, but you're gonna, if I'm looking over here, it's because I have two monitors and that's where my notes are. So just a FYI. But your debt to income ratio is basically going to look at the amount of income you have versus your credit reporting liabilities. And it's going to be looking at the minimum payment of those credit liabilities. So for most loans, especially FHA, conventional, they want you to be at 30%, 6% or less of debt to income ratio. But for FHA loans, I have seen it go as high as 43% debt to income ratio, but that's based on your overall credit strength, meaning how high your credit score is. The higher your credit score is, the more flexibility you'll have with debt to income ratio, your on-time payments, your credit worthiness. If you pull your credit report, and you can get a credit report from annualcreditreport.com, it's a very trusted website. It allows you to get your credit bureau reports, I think, one time a year free. I think at this point, you can get it even more frequently because of everything that's going on with COVID and fraud and stuff like that. So please pull your annual credit report, print it out, highlight your negative items, what's considered negative, late payments, defaults, charge-offs, past dues, paying less than the minimum balance, not paying on time for more than one creditor. These are all things that are going to have a negative impact on your credit score. However, if you know that information up front, you can do something about it, right? If you know, you can do something about it. And what can you do about it? You're going to reach out to a credit repair company. There are actual strategies and effective methods that you can use to repair your credit that absolutely 150% work. I have not used them personally, but I know people in my personal life who have taken advantage of credit repair companies, and they do a fantastic job of fixing your credit. I know somebody personally who had like a 585 credit score, and right now they have almost a 700 credit score just by working with my friend Leah Scott, who is a good friend of mine and does credit repair on in addition to her day job. That's her side hustle. There's another great girl that I found on YouTube. I actually came across some of her videos, and I wanted to highlight her in this presentation. Her channel is called Road to 750. She's a Black girl, and she goes through step by step how you can repair your own credit from like a DIY perspective. I mean, she's absolutely phenomenal. Please check out her channel. After this presentation, after it processes, I'll link her channel down below. But she teaches you how to repair your own credit by sending first round letters, second round letters, third round letters, and exactly what you need to say to the credit companies to get these negative items removed. So then the next step you want to think about is finding a lender. You want to decide if you want to get what's called a FHA loan, which is a federal government backed loan, or if you want to get a conventional loan, or you want to go with a private lending company. All three are going to have their different benefits. For a FHA, we're going to talk about that on the next slide. We're going to talk about conventional. What we don't talk about is private lending companies, because it's not something that I necessarily recommend. It's usually for people who have a very, very poor credit. A lot of people who are self-employed typically go with private lending companies because they have a lot more flexibility, and they do like hard money loans. They add points to your loan and stuff like that. So it's not something that I would recommend, but if you're in a unique situation, it is something that you could consider. The next thing you want to think about is considering your down payment options and your closing costs. So I'm going to go through exactly what some options are for down payment and what exactly is included in closing costs later in the presentation. We're going to talk about your team, right? You need a realtor, a lawyer, a title company. You're going to need 1 year of homeowners insurance that you will have to pay for upfront. Yes, you have to pay for 1 year of homeowners insurance upfront when you buy a house. You're going to pay for inspections. And then you're going to pay for your, your closing process. So these are all the things we're going to go through in this presentation. I'm going to give you a step-by-step guide of like how to handle all of these different milestones within your home buying process. So credit profile, we talked about that. DTI has to be 36% or less for FHA. I mean, for conventional loan, but for FHA, you can go as high as about 43%. I've actually seen some people get a debt to income ratio, FHA loan at 50% debt to income ratio, but that is truly based on having a very strong credit score. What is the minimum credit score for FHA loan? It is a 580. right? That is the lowest credit score you could have to qualify for an FHA loan. For a conventional loan, you're usually looking at a little higher, somewhere around a 620. It's probably going to get you qualified for a conventional loan. But remember, FHA loans are federally backed loans, and so they have benchmark interest rates. Like, let's just say the FHA is a published rate, which means you know what the rate is going to be on your loan upfront because the government publishes this rate. With a conventional loan, banks like Bank of America, Wells Fargo, Chase, TD, whatever bank you use, they set your interest rate based on their overall risk assumption of your profile, and that rate can vary from borrower to borrower. Very, very vastly, right? Somebody can get 4.25 on their mortgage. Another person might have 5.25, and the only difference is their credit score. If you go with an FHA loan, there may be slight variation in the rate, but you're going to be talking about 25 basis points. So instead of a 3.75, somebody might have a 4%, or they might have a variable rate instead of a fixed rate. But you're not going to see that large swing that you would see with a conventional mortgage. So that's another benefit of FHA. What's included in your payment? So there are a few components of a mortgage payment. I forgot to add taxes. See, I found my own error here. So the first thing is principal. The principal is the base amount that's going to pay down your loan every month, right? That's the principal portion. There's interest because home loans accrue. When we talked about this, and I did in my last live, I talked about and with student loans, I talked about capitalized interest versus straight line simple interest. Yeah, so home loans have daily compound interest, so you can accrue interest daily on your home loan. So you're going to pay that. Within your payment, you're going to pay mortgage insurance. So mortgage insurance is if you put less than 20% down on your loan, you're going to have what's called private mortgage insurance, which is basically the bank goes out and takes out. Think about it like car insurance, right? They're hedging their risk. So if I'm going to loan you this money and you're putting very little down, the bank has to account for the risk between housing price fluctuations and your outstanding balance on the loan in any event that you went into foreclosure. So they hedge that risk by using private mortgage insurance. You pay for that monthly. So that's added to your loan payment. And that is usually around depending on how large your loan is. It's based off the size of your mortgage, but it can vary. But you will pay that if you put less than 20% down. And then taxes. So taxes are going to vary based on where you buy your home. If you have $5,000 in taxes, you're going to take that $5,000 divided by 12, and that is what you're going to pay per month in addition to these other items in order to cover your mortgage payment. So it adds up pretty quickly. So that's very important because some people just think, oh yeah, I qualify for this, I'm going to buy this, and they forget about those other things that do get added into that. And for the first year, right, your homeowner's insurance is paid up front. So that's not going to be included in your payment. But when you refinance, when you go to the next year, you didn't pay homeowner's insurance. So now your homeowner's insurance premium, when you renew it, the homeowner's insurance company is going to send that bill to your mortgage company, and your mortgage company is going to add that to your loan payment. If you don't pay it separately, you could just write the homeowner's insurance company a check and then it won't be included. But if you don't, they'll add that to your mortgage payment and you'll pay that monthly in addition to the rest of these things as well. So what's not included? They don't include things like in your credit profile. They don't account for payments on PSE&G, daycare, or non-credit reporting items. So if the item is not on your credit report, it's not going to be a factor in calculating your debt to income ratio. So if it's not in your credit report, it don't count. Now, your debt to income ratio, think about it like this. Add up every minimum payment you have on your credit report, every single minimum payment. Take that amount, add them all up in an Excel spreadsheet. Then calculate your gross income. Pull out your last tax return, your 2020 or 2019 if you didn't file for 2020 yet. Look at that top line number, gross income. Take that number and divide it by whatever number you got from all of your expenses. If that amount is not 36%, multiply your gross income times 0.36 is another way to do it. Take your gross income, multiply by 0.36, you're going to get an amount. If that amount is greater than or equal to your expenses, then you're in the money, right? If that amount is not, then you're going to have to think about paying down some debt in order to make sure you qualify for a loan at the best possible rate or that you can even get a loan. So these are some metrics you want to remember. So I talk about this, disqualifiers. So there are some things that will just absolutely prohibit you from getting a FHA loan, just absolutely prohibit you. Number one, student loan defaults and charge-offs. If you mess around with Uncle Sam and his coin, if you play about his money, He ain't giving you nothing else. Don't mess with the federal government and his money, because you may think you're getting over a little bit here and there, but if you default on any kind of federal debt in the past, you will not qualify for any federally guaranteed programs ever, never, never, not never again. So be very careful with student loan defaults and charge-offs. Again, if you default on a student loan, if you're past due on a student loan, please talk to a credit repair company. These are things that they can get removed from your credit report. They can write a letter. They can get these things taken off. They can get the what they call a goodwill, whatever. It's called a goodwill. You file like a goodwill letter, and they basically will take off the late payment in good faith, right? It's like a good faith letter. That's what it's called. But remember the girl Road to 750? I'm going to share a channel with you. I think Denise shared her with me. Denise is probably in the chat. I believe Denise first shared her with me, and now I'm sharing her with you. I think Denise sent me so much stuff. I'm not sure, but I know she's amazing. So you want to do that. Oh, here's some other disqualifiers. Foreclosures. If you ever had a foreclosure in the past, that is probably going to be a sticky situation. Short sales. Short sale is basically when you default on your home loan and the bank has to sell it for less than what you owe on it. That's called a short sale because the bank took a loss. On paper, you know they're gonna write that debt off and collect the insurance money, but they're gonna ding you for it. That's how they do. But yes, a short sale, you don't want that. In a bankruptcy. So bankruptcies, whether you go chapter 7 or chapter 13, they have different time limits. I think chapter 13 stays on your credit report for 7 years and chapter 7 is 10 years or reverse. I'm not good with bankruptcy. I know one is 7 and one is 10 years, but that is like something that will absolutely be a barrier to entry when it comes to getting a home loan. So let's talk about the FHA loan in a little bit more detail. What are the benefits of the FHA loan? It's one of my favorite loan products. I have to tell you, a lot of people look down on FHA loans, first-time homebuyer mortgages. They think you're poor. They think, oh, you're not a credit-worthy borrower. There's all these stigmas around FHA loans, but I, for one, am a big supporter of FHA loans. I have an FHA loan. I always had an FHA loan, and as long as I can get an FHA loan, I will get an FHA loan. A FHA loan is not based on income. A FHA loan is based on whether you are using that home as your primary residence. You can get as many FHA loans as you want as long as you only own one home. So if I sell this house tomorrow, I'm going to go out and get me a whole nother FHA loan because there are a lot of benefits to it. You can also get an FHA loan. There are provisions in the FHA guidelines that allow you to get an FHA loan for a second residence, but there are very strict guidelines around it, and it's usually if you have to relocate and the cost of rent is so expensive that it's cheaper to buy a house, and you got to submit all this data to the FHA program. But if they agree, they will allow you to have 2 FHA loans at one time. But in general, you can only have one, and you only have to put 3.5% down. They have a max loan to value of 96.5%, which means you can borrow up to 96.5% of the property value. That is what they'll give you for FHA. It does require private mortgage insurance plus an upfront mortgage insurance premium. So PMI is what's added to your mortgage payment every month. Upfront mortgage insurance premium is a one-time fee that you pay. It's based on the size of your mortgage, but it can range from a couple $1,000s, and it's added to your closing costs upfront. However, the FHA does allow you to finance your upfront mortgage insurance premium, so you can roll that amount into the cost of your loan, and it will just be amortized over the 30 years that you have a home loan. So if you don't have that money out of pocket, you can't finance it. So you have to pay closing costs when you have an FHA loan. What are your closing costs in an FHA loan or in any loan that's a home loan? It's going to be your title. It's going to be your lawyer fee. It's going to be inspections. It's going to be your down payment and your application or origination fee. So those are your closing costs. That is the money that you have to pay out of pocket, bring to the closing table in order to sign on the dotted line. I'll talk to you a little bit more about what the role of each of these people are when I get to the pick your team slide. We'll talk about that more, but those are what you need to look out for. A FHA loan is federally insured. This is why I love FHA loans, because the government don't play about their money, which means if times go bad, COVID, job loss, the economy tanks, the people who have Freddie Mae and Fannie Mae back loans or FHA back loans, you can call your lender and they will offer you programs that you might not ever be able to access if you had a conventional loan. They will make sure. The government does not want to foreclose on you. The government does not want that house back. The government don't want to be selling property. So if they are insuring that mortgage, they don't want you to default because they promised the bank, like Bank of America, Wells Fargo, Cross Country Mortgage, what do you call these other mortgage companies? Whatever mortgage company you have, they have a contract through. That's what the insurance is. Meaning, if you default, the government has to pay them for their loss. The government don't want to pay that money. So the government is going to offer as many programs as possible to keep you inside of that house. Extensions, forbearance, loan modifications, the works. So to me, it's a good product. If you're not putting 20% down, to me, a FHA loan is a no-brainer. If you have 20% to put down, you go ahead and do you, boo. But that's my thing. And another thing with FHA loans is you can get what's called a 203K renovation loan on top of your FHA loan. So you can go and buy a house in a really nice area that needs work, and you can take out a 203K rehab loan to actually repair that home while you live in it. And that amount gets added to your mortgage payment, and you pay over 30 years. So say, for example, you find a house in a beautiful area and you pay $200,000 for it. You can go to the FHA and say, well, instead of just getting a conventional FHA loan, I want a 203K renovation loan, which means I want you to not only give me a mortgage for this house, I want you to do it as is. Yes, these rules apply to all states, Mike. Yes, this is a federal program. So if you live in the United States, you can take an FHA loan. So if you, let's say you have a $200,000 home and you want $100,000 for repairs, you can go to the FHA when you're about to buy and say, I want a 203K renovation loan. The FHA will do what's called an as-is appraisal, which means they'll say, this is what the house is worth right now. This is what the house is going to be worth once Denise or Michelle refinances it. They give two appraisals, and they will lend you 96.5% of the post-completion value. So based on your contractor, the repairs he's going to do, is whether it's a new roof, paint, a new bathroom, in addition, you can get an FHA loan from a house that's you done about to knock down and put back up. Did you know that? You could do that as long as you keep the foundation. So you have to keep at least one structural wall and a piece of the foundation, and you can get a 203K loan. The great thing about a 203K loan is actually you can roll 6 months of mortgage payments into your 203K loan. That way you don't even make a mortgage payment while your home is being renovated. So you can sit back, relax, and drink your coffee while the contractors are fixing your house for 6 months, and you will not be making a mortgage payment because you can roll those payments into your loan. It's a great product. It's amazing for people who may not have, $1 million to buy their dream home. But you know what? I got $350. And I want to live in this really nice area with a good school system. Let me take a 203K. If you're interested in these products, you can get a FHA loan from any bank. All banks do FHA loans. Some banks, I believe all banks do 203K, but if they don't, you can always go to it. You see this link here, HUD Rent Program Office. I'm going to put the link in my description box down below. But if you click these links, they give you more detail about these products. I'm going to go ahead and click it just so I can show you guys. So yes. It'll tell you exactly take you exactly through a 203K mortgage insurance, what type of assistance it provides, what it covers, structural alterations, moderations and improvements, elimination of health and safety hazards, adding or replacing a roof, gutters, downspouts, adding or replacing floors or floor treatments, major landscaping work, enhancing accessibility for a disabled person, or making energy conserving improvements. So you can actually get a loan like this, like right out the gate, 3.5% down. And you know what? There's an even better program out here that we're going to talk about later on in the presentation. But this is an amazing option for somebody who may want to buy in a nice area and might not be able to afford to live there today. Pending. Buy the ugly house on a nice street and work your way up. So here's another rule about FHA. So the home must remain your primary residence for at least 1 year. So if you want an FHA loan, you got to live there for a year. And after a year, you can go ahead and move, and it can become an investment property. But you cannot get a second FHA loan until you sell the current one. But you can go out and get all other kind of mortgages, which would be conventional. So, hopefully, you could take your first house, buy it low, do a 203K, flip it. Oh, heard that word? Flip. You could flip that house like Chip and Joanna Gaines, right? Do your renovations, flip it, live there for a year, sell it, and you make your money. That $100,000 that the FHA gave you might turn into $150 when you sell it. I know somebody who did a 203K renovation, and they sold their house for about $100,000 more than they bought it for. Yes. and they only lived there for a year. So true testament, two people that I really know who are my friends actually did this and made a boatload of money. And you could do it too. You could do it too. So just a little tidbit. Okay, so what are some cons of FHA loans? The home sellers dislike this product because when you say FHA, the first thing they think is this person doesn't have any money. This person is not going to be able to get the mortgage approved. This person is a risky borrower. They get scared of FHA, but don't let that scare you. Okay, don't let that scare you. You go ahead and do what you got to do, what's best for you, and they'll get over it. If they don't have any other offers, you know what, they're going to take what they can get. So that's one thing. The assumption about less than creditworthy borrowers. Oh, PMI for the life of the loan. So that is one con of FHA loans. So with a conventional mortgage, PMI generally falls off after you hit a certain loan to value. So I think once you hit 85% or 80% loan to value on your mortgage, they will take the PMI off. So you can actually call the bank up and say, hey, I want to order an appraisal on my house for $500 because that's how much an appraisal costs from most homes. And you can say, I want to order an appraisal for my house and see if I can get my PMI taken off if the house appreciates. And so you can go to the bank will order the appraisal. If it does come in good, the bank will actually drop the PMI off your loan. And so that could be $200, $300 a month in savings if you have a conventional loan versus a FHA loan. So that is one big consideration that you have to make. But if you don't plan on living in this house for the rest of your life, you can always sell your home at any point. You can refinance out of FHA into a conventional product. People do it all the time. There are flexible options. Don't let that scare you. Okay, it's just something that matters. Here's the biggest benefit of an FHA loan. You see, I put it in purple because it is a highlight. The FHA program allows you to do something called a streamlined refinance. What is that? I'm renting for 6 months and everyone is offering $20K more than price and inspections are. Yeah, I know, KH. We're gonna talk about that. Don't fall into the trap, right? We're in a housing bubble, and we see, I'm about to get derailed. I'm gonna pin that because we're gonna come back to that. But yes, so you could do a streamlined refinance when you have an FHA loan. So say, for example, I have an FHA loan. When I closed on my house, let's say I will tell you a true story. We bought our house. Our interest rate at the time was 4.75%, right? As long as you have 6 months of on-time mortgage payments, when interest rates fall, which they did, you can do a streamlined refinance, which means I call up my lender and I say, hey, Mr. Lender, I have 6 months of on-time payments on my FHA loan. Current mortgage rates are 3%. I want to do a streamlined refi. And guess what they do? They say, sure, no credit check. Okay? You do have to have a 620 credit score. As long as you have a 620 credit score, you don't have to go through the underwriting process whatsoever. No, you don't have to submit your tax returns, your personal tax returns, because that's all the financial information you have to submit to do a home. You have to submit 2 years of personal tax returns, bank statements, pay stubs, proof of down payment. You got to write a letter explaining any late payments you might have on your credit report. You got to do this whole song and dance to get a home loan. But if you do a streamlined refinance because you have the FHA product, you do none of that. They do a soft inquiry on your credit. As long as you have a 620, you get to refinance into the lowest interest rate that's being offered to the market. And you pay how much out of pocket? Settle. And guess what? You get to skip a mortgage payment because it's like buying a house all over again, except for you didn't do anything. You didn't even leave your house. So you get to skip 1 month of mortgage payments. Sometimes 2 if you do it in October. That's the secret. Do it in October. You can skip 2 payments. You can skip 2 mortgage payments potentially, definitely 1. And you can get the interest rate and you didn't have to do anything but a soft inquiry on your credit report. To me, if you had a conventional loan, you'd never be able to do that. The bank would ask you to start over as if you Jenny from the street. They don't care. They want all your information all over again. So like I said before, I love the FHA product for that reason. It literally truly does benefit people who are first-time home buyers who make mistakes when buying a home. They don't know about what points are. They don't know this. They don't know that. The federal government tries to accommodate you. They don't want you to lose your house. So if rates drop, they're going to drop your rate too. So make your payments on time because that's the one thing. If you miss, I think you're allowed to miss 1 payment within a 12-month period, 0 payments within 6 months in order to do a streamlined refi. So no more than 1 missed payment within 1 year. But if you didn't have that and you got a 620, you could do a streamlined refi. And you could have a 3% rate right now on your house. And you ain't even moved. Now look at all this equity because now, like KH said, houses are going crazy over market. Okay, so what's a conventional loan? A conventional loan requires at least 5% down. But if you put 5% down on a conventional loan, you are going to have PMI on your loan. So if you're going to have PMI anyway, you might as well get an FHA loan. If you put 20% down, you do not have PMI on a conventional loan. But if you don't have good credit, it doesn't matter about you putting 20% down. If you have a credit score less than, I want to say, 720, you are considered fair credit, fair to good. If you're less than 720 and your rate is going to be higher than somebody over 720. So keep your 20%, put your 5% down, and just, refinance out of the FHA product after a year into a conventional loan and do that. That's my advice. If especially right now with housing prices being as inflated as they are, everybody is below the threshold to not need PMI. Everybody, because home prices are crazy. So here's a way where you could literally refinance out of PMI and you don't have PMI anymore and you only put 5% down on your house or 3% down on your house. I mean, it's a no-brainer to me. But so Bank of America does have a product right now that's offering only putting 3% down. It's thebomb.com. The Bank of America is also giving out grant up to, I think it's $17,500 right now for first-time home buyers towards your closing costs and 3% down. What? Yes, Bank of America is out here winning. And I put the link in the presentation. We'll get to that slide and I'll show you guys how to find it. But it's also going to be in the description box after this. So you have to pay closing costs if you do a conventional loan, which we talked about what the closing costs are. Your rate is obviously based on creditworthiness. It can fluctuate vastly based on creditworthiness. You can Google predatory lending lawsuits and you'll see how vast the interest rates can fluctuate, even if you have the same credit score as somebody who don't look like you, meaning they're not melanated. The system, like car insurance, they assume what the risk of loss is, whether you're married, whether you're single, whether your race. People say it's not built in. It is built in my opinion. These are my opinions. Don't sue me. I said it's an opinion. But people based off certain factors, demographics, age, location, they could back into it. You know what I mean? And there are lawsuits. So I'm not making this up for predatory lending. So that's all I'm saying. Protect yourself and just go with the feds. Go with the government. So yes, if you do a conventional loan, your home can automatically become your investment property. There is no requirement for it to remain your primary residence for a year because you did a conventional loan. You can do whatever you want. Unless you take the grant program that Bank of America is offering, then you have to keep it. I think they want it for 5 years. You got it for 5 years. I think I'm gonna reread it. I read it a couple of days ago, so I don't remember, but I think it's 5 years. Okay, conventional loan cons. You can't do a streamlined refi if you have a conventional loan, which I talked about. It's less flexible in times of distress. So right now, COVID, a lot of people have lost their jobs. A lot of people are going to banks asking for forbearance, asking for loan modifications. With conventional loans, the flexibility is just not the same. You may get one extension, you may get a modification, but they can absolutely tell you no, and they come to get their property. I know Biden has like a stay on foreclosures right now, so they can't legally. But as soon as that moratorium is up, there are some banking companies who will offer you to refinance your whole mortgage for 30 years. That way your payment only goes up a little bit if you've missed payments. And then there are some banks that are going to say, no, cut me my whole check. You missed 4 mortgage payments at $3,000 a pop. I need my $12,000 on the first of the month, or we're going to start foreclosure proceedings immediately. So, that's something else that a lot of people have to be concerned about, which nobody should be concerned about, in my opinion, but it is what it is. And there's less flexibility with underwriting guidelines. So when you have a conventional loan, it's usually in the box underwriting. If you fall into this box, that's your rate, that's your term, whatever. You fall into this box, same thing. With FHA, it's flexible. You can talk to the underwriters. You can get a little bit more creative. As I said before, I've seen people get FHA loans at 50% debt to income ratio. It happens. It's all about credit worthiness, credit strength, length of your credit profile. All of that stuff comes into play. So a little bit more flexibility. Down payment options. Actually, should I pause for questions? I feel like I'm just going. I gotta let y'all in. I'm like me. I get into my zone and I just be knocking it out. So does anybody have any questions before I proceed? Rob asked about USDA loans. This is not the purpose of this presentation. So if you want to learn about USDA loans, boo. I'll do a presentation on that for the next time. I just want to focus on conventional versus FHA in this presentation because then we'll go down rabbit holes that I ain't trying to go down. And then Okay, so anything up until this point. So what are some things you should look for when hiring a real estate agent? I will talk about in the next couple slides. And I think that was it. If you think of any question as I made it to this point, type it in the chat. I'll pause and answer your question. And then for now, I'll keep going because I don't see anything. So down payment options. How can you get a down payment for a loan? For your home. Okay, the first option is obvious, save. If you're buying a $100,000 house and you have to put 3.5% down, that means you're putting down $1,350, right? 3.5%. No, 3,000. Lord, look at my math. Jesus, $3,500. I'm gonna say 1,000. Yes, you have to put down $3,500. So for every $100,000 you borrow, you're putting down $3,500. You can save. That's option one. You can borrow from your 401k. So most 401k programs allow you to take a loan from yourself at the prevailing interest rate, but you're paying yourself back, so you're not borrowing it from a bank. And you get to continue to realize your capitalized gains, which is amazing, right? So let's just say you have $50,000 in your 401k and you want to take $10,000 out for the purpose of purchasing a home. You go to your Merrill Lynch or Charles Schwab or whoever manages your 401k program, and you say, I want to take out a loan from my 401k for the purchase of a primary residence. They're going to say, well, how long do you want to take to pay this back? Some of them will allow you up to 10 years. Some are 5, some are 2. You can pay back as fast or as slow as you like. They're going to divide the amount that you borrow over the amount of payroll payments that you would have received, and they're going to take that money out of your paycheck pre-tax every time you get paid to pay you back with that loan. They'll usually charge you prevailing interest. Right now, that interest rate will probably be somewhere around 4%. 3.75 to 4%, but you're paying yourself back and your money remains invested in the market. So you're still getting capitalized gains, which is offsetting the interest that you're paying. So as long as the market is growing rapidly, which we've been in a bullish market, we took my investment course, we talk about this. I ain't going to go down that road because I could derail, and we ain't going to derail here. But as long as you're earning more in capitalized gains than you would be for the interest you're paying on this money, you're in the money and it's not that big of a deal. One of the downfalls of doing that, though, is if you leave the company, it becomes a withdrawal, which means now you have to pay a tax penalty on it. So it kind of makes you have to be like, ooh, if I borrow 10 from my 401k, but I know I don't really like this job and I'm trying to get up out of here in 18 months, and you leave, that withdrawal, unless your plan offers you to continue making loan payments. Some plans do. I know Merrill does. It depends on your employer how they set it up. That's not up for you. You got to ask your specific employer program. However, you can still make the loan payments. Some programs offer that, but majority of them, it automatically, hey T Webster, it automatically becomes a withdrawal. And at that point, you have to face the tax penalty. So there's a 10% tax penalty that you have to pay on top of it becoming income, because now it becomes income. That's going to increase your tax bracket. Then it's going to become income, increase your tax bracket. Then you're going to pay a 10% tax penalty on top of that. So it could really mess you up for your income. If you like your refund check, that can really throw you off balance. However, there's another option. There's always options. Talk to your provider. You can roll that money into a Roth IRA. So you can do an indirect Roth rollover, and that can offset your tax liability. So if you took $10,000 out of your 401k to buy a house, you decide you don't want to work there no more, you quit your job, they send you a letter saying you are in default of your loan. It now becomes a withdrawal. You're going to pay a tax penalty. You can pick up the phone. You can call them up and say, I want to open up a Roth IRA, or you can go online, open up a Roth IRA, and you can actually make a contribution to your Roth IRA. As long as that contribution matches the amount of your withdrawal that you took during that same tax period, you can offset it through an indirect Roth contribution. That's more sophisticated, different conversation, different presentation, but there are ways to offset it. I think Trump might have passed something where you can get a modified reduction on the penalty if you use it for the purchase of a home. I don't know if Biden going to roll that back, but I know Trump did something with that where you was able to get, in 2020, he hooked it up some way so you wasn't paying it if you, like when you press the drop down box. But I don't know if Biden gonna roll that back. So I'm giving you the real rules, right? But there are sometimes the president passes these favorable things to stimulate the economy. Okay, so Grants. So as I talked about before, Bank of America is offering a grant program. So I'm going to go ahead and click this link so we can go ahead and look at it. So I'll put this in the description box. But right now, Bank of America is offering something called Our America's Home Grant Program. They're giving a lender credit up to $7,500, which can be used toward non-reoccurring closing costs like title insurance, which you're going to have to pay, recording fees, definitely going to have to pay, or to permanently buy down the interest rate. Remember I talked about points? That's what points are. Points are, they add points to your interest rate. You can buy them down up front. But people that's why you got to read your loan documents, please, people. We're going to talk about that later on in the presentation. It's very important that you read your loan documents because sometimes you think, oh, my rate only 3.25, but no, they got 2 points. They added points to it. So now that's not really your annual percentage yield. It's a whole different number. Read your docs. But you can buy those down through this grant program that Bank of America is offering, and you don't have to pay the money back. Okay. Now they're offering another grant. So it's the grant equating to 3% of the home purchase price up to $10,000, which can be used toward a down payment in select markets. So if you're not sure if your market qualifies, go into any local Bank of America branch. Go online. They have a contact us button. Ask to speak to a mortgage loan officer. Tell them you're interested in the home grant program. Ask them if your area qualifies. You can get a $10,000 towards your down payment. So remember I told you, if you do an FHA loan, it's 3.5%. Well, for this, they have their own program going. So they only want 3% down. Right? So that's only $3,000 for every $100,000 that you borrow, which means you can get a house for $250,000 and probably only got to pay how much out of pocket? $500, because they're going to cover your title. They're going to cover your recording. All you got to do is pay your attorney fee, your mortgage insurance, which is about $1,000 for a year or $800 for the year, depending on how much your house is. So attorney, homeowners insurance, and probably like your interest, the daily interest that you would have to pay up until for the remainder of the month. Because, you pay homeowners, you pay your mortgage in arrears, right? So you might have to pay your daily interest. You do, not even might, you will have to, and part of your closing fees. But all in out of pocket, if you bought a $250,000 house, you might have to come out of pocket $3,000, $3,500, and you can get a $250,000 house. That's a stimulus check. 2 stimmies. If you got kids, that was 1 stimmy. You could have bought yourself a house using this Bank of America program. This is why information is critical to the people, So you only got to put 3% on a mortgage down. It's a fixed rate option. You heard that, fixed rate, not variable, which means not going to float, which means your interest rate will never change. If you have a variable rate, your interest rate is based on how the market is doing, which means if the rates go up, your rate goes up. If rates go down, your rate go down. There are pros and cons to variable rate loans, different presentation, but for this option, it is fixed. So that's the Bank of America program. I'll put the link in my bio and the description so guys can read more into it. Okay. So another option is gifts from family or friends, but you must have a gift letter. If you do not have a gift letter, if somebody just say, oh, Tamara, I want to help you buy a house. I'm going to give you $5,000. And they just put the money in your account. They wire you, they Venmo you. The bank is going to analyze your bank statement with a fine-tooth comb, okay? The bank is not playing about money laundering. They want to know the sources and uses of cash. They want to know where this down payment generated from. Was it from a bonus? Was it from savings? Was it from your paycheck? They will analyze your bank statement with a fine-tooth comb. You're not going to be able to sneak nothing through the cracks. Okay, so if you have a large deposit come in, the bank is going to ask you to explain where this money came from. If you're buying a house, you will explain every out of sync deposit needs to be explained by a letter in writing, and they're going to make you sign it. So if somebody wants to give you money to buy a house, which is fine, they can, they must give you a gift letter. Otherwise, the bank will assume it's a loan. So if it's a loan, that means the bank is going to add that to your debt to income ratio calculations. So they'll assume, if someone gave you $5,000, they're going to use prevailing interest divided by 5 years, and they're going to add that to your DTI. But if they get a gift letter and they sign it, get it notarized, it's a gift, it's fine. So remember that as well. So find your team. That's the next step. I'll answer these questions, Rob, in a second. They're good questions, but I'll answer them toward the end. So find your team. So first person you want to find is your realtor. Your realtor, you should find somebody who sells homes, a lot of homes in the area you want to move to. Don't just pick somebody willy-nilly. Don't pick a real estate agent who lives in Elizabeth or sells homes in Elizabeth and you live in Montana. No, you want to pick somebody. If you want to move to a certain town in a certain area, pick a realtor who either lives in that area or who sells a lot of homes in that area. And you can ask them, you can say, I want to see the last 10 homes you sold in this area. They had that stuff is recorded in the system. They could say, oh, I've sold 15 properties in this area, which means number one, they know what the schools are like. Number two, they know what kind of offer you should be making in order to stand out. Three, they have contacts. Most important, they know the realtors in that market, which means when you really, really love a house, this is how we got our house. I'm gonna tell y'all a little, I digress for a little story. Our house was on the market. We bought our house $75,000 less than what it was listed for. I think I told the story in one of my other lives. $75,000 less. This is a very competitive town to live in. A lot of people want to live here right now. We could probably sell our house for a lot more than what we bought it for because the market is crazy. And we got the house because our realtor knew the other realtor and was able to sell the story. She had she had 4 sons. I had 3 sons. She wanted to sell to a young family. She loved the fact that I had boys. I hit it off with her kids. We got along. We were laughing and joking. We made a personal connection. That's how we got this house. If that wasn't the case, if our realtor wasn't so connected to this area and didn't know all the players and movers and shakers, we wouldn't have got this house. Sometimes it's about your team. Money is money. People want to make money on their homes, but sometimes that little bit of extra, that little bit of connection could be what makes the difference. So I always say, find a realtor who knows the area you want to live in very well and who can advocate for you. And school system. So when you talk about resale value, you can't move the house. Like, you could buy an ugly house in a good neighborhood and it could be the ugliest house on the block and you'll still make money. If you buy the best house in the worst neighborhood, you're going to be done for. You can't relocate the house. You can fix the house, you can't move the house. So always location, location, location. I always tell people that. Your lawyer's role is to explain the loan docs to you and help you negotiate repairs when you do your home inspection. Lawyer is very important. If you got a lawyer doesn't really understand real estate, never hire them. You want a real estate lawyer, somebody who knows real estate law. Don't hire the family lawyer. Don't hire the intellectual property lawyer, entertainment lawyer. Yes, a lawyer is a lawyer and all lawyers can close real estate transactions. They sure can, but you want a real estate lawyer because you want to know that if there are challenges with title, if there's liens, if there's wetlands, marshes, these are things that could destroy your property value. Okay, they could destroy your property value. And if your lawyer don't know of these rules and regulations, you'll be screwed. So get you a real estate lawyer. The next is a title company. So the purpose of a title company is to find liens that's on a property, which means they want to make sure you don't buy a house. If you don't do a proper title search, this happens. There's horror stories. You could buy a house, and let's just say the owners of this house got their roof done in like 2005, right? They got their roof done. They never paid the contractor. They went ghost on him. We bought this house, didn't do a title search. The contractor put a lien on the house. He put a lien on the house. We decided, we got cash. We're going to buy the house cash. We ain't going to do no title search, whatever. When we inherit that property, now we owe the contractor because the lien is on this house, which means he can put a lien on our deed. We can't sell this house. He could try to take our deed. He could cause all kind of havoc. Title searches are extremely important. Get a good title company. They help to define your property lines. They make sure that you don't have no encroachments. That means that somebody's fence is not on your property line, which could prevent you from reselling. They do everything. They find swamps. They find marshes. They find old abandoned septic systems. Yes, old abandoned septic systems. Back in the day, before they had plumbing hookups and before the water came from the street, the poop used to go into a septic tank back in the day. And some people didn't have those removed and they didn't have the soil tested. They didn't get a no further action letter. So you could literally have poo in your backyard. And if you don't do these inspections and you don't, which we're going to talk about, you got to do home inspections. Do not forego that. These people out here waiving home inspections like crazy people because they want a house so bad are just plain flat out stupid. Just plain flat out stupid, because you could have an abandoned septic tank in your backyard. And if that is the case, when you go to sell and the housing market calms down and somebody comes out with their little machine, those little radar things, GPS, ground penetrating radar, and they find that metal, they're going to make you dig up your yard and find out what's down there. If it's an abandoned septic tank, guess who's responsible? You, because you own the property, not the previous seller. They ain't no calling them back saying this your problem. Y'all did this to me. Woe is me. The judge don't want to hear it. It's your responsibility. If the soil's contaminated, that's you that got to put new 6-7 inches of soil down. This is if there's asbestos, okay, lead, asbestos, all of these toxic things that are terrible things. You should not be waiving inspections. I don't care how much you love a house. Don't waive inspections. I've heard, I promise you, with commercial properties, I've seen people inherit properties. They wanted it so bad. They didn't do the proper due diligence. They paid cash for it. Now they got $1.5 million liens against their property from the Environmental Protection Agency. $1.5 million they got to pay to do a oil cleanup because it was an underground storage tank that leaked underneath the soil. Millions of dollars. That is a big no-no. You see how much time I spent on that? Do not do it. I don't care how much you want it. No. Don't let your realtor tell you no craziness like that. As a matter of fact, if any realtor would tell you to do something like that, you should be concerned. And I know even you should fire them. I'm not even going to say concerned. That's automatic grounds for termination in my book. It's automatic grounds for termination. You tell me to forego inspections. Now, there's certain inspections you may say, oh, I'm a duty inspection, but I'm not going to ask you to make repairs. You could say that. Okay, I'm cool with that, which means I'm a duty inspection. If I find something I don't like, I'm not going to ask you to fix it. I'm going to fix it myself, but at least I'm going to know what's there. But to go into a house blind, no. Okay. So what was I about to say? Dang, I lost my train of thought. And you want to have a partner or a family friend for emotional support. There will be a lot of losses in the home buying process. A lot. We lost many homes when we first were trying to buy our first house. I want to say we got outbid on about 19 homes. You get discouraged. You feel like you're never going to find a house. You feel like it's never going to happen. You want to quit. Don't quit. Stick with it. The house that's meant for you will find you. It will. Just have some patience and do not get panicked by this market, because a lot of homes are being overappreciated and overstated in value. And when the housing bubble levels out, you don't want to be underwater on a home. Look at what happened in 2009, in 2008, 2009. All those people with those adjustable rate mortgages when the housing market tanked. That can really happen. Homes were overinflated in value in 2006, 2005. And then when the market leveled out, these people couldn't sell their house. They bought $350 on a house in Florida. It's worth $125 now. They buried. Don't panic about this. You know, if you got to rent for another year, you got to let the market level out. Let it level out. You can overbid on the house, but there's a big difference between $5,000 and $50,000, $60,000, $70,000. Don't do it. Especially if you don't have a lot of savings. Now, if you have a lot of savings and you want to do something like that, and you know that you want to live in this house for 10, 20, 30, 40 years, then you can overbid on a house, because obviously this is not the first time the market's going to inflate. The market will inflate again, in 7 years. And then at that point you could sell and get your money back. But if you know you're the kind of person that's only want to stay there for 2 to 3 years, 3 to 4 years, don't do that, because you'll be stuck and you'll take a loss on the house and you won't be able to sell it. Okay, so finding your home. So stay under your budget. So when you get a pre-approval, as again, you'll send your tax returns, bank statements, payroll stubs, credit report to the bank. They'll give you a pre-approval letter. That's going to be some outrageous number. It'll be more money than you ever thought you could get for a house. Don't buy a house for that amount. Okay, try to stay under budget. The pre-approval is giving you the max possible amount you can borrow. I say shave 50, 60,000 off that number, depending on how big your number is, and buy a house for that amount. You don't want to be house poor. It happens to people. It can happen to you. Don't be house poor. If you can't be reasonable with it. You can fix the house. You can't relocate the house. This is when it comes to the 203K rehab loan. Definitely look into that. And remember to ask your realtor for comps. So before you put a bid on a house, don't just go in blind. Like, I want to bid. I don't care. I'm paying full price. Ask your realtor, say, can you print out the last 10 to 15 houses that sold in this area with 3 beds, 3 baths, and a finished basement. And then make your offer based on what homes are selling for. Because sometimes you get into this process, you overbid, it appraises, it doesn't appraise, and now the seller's looking at you saying, well, you bid the amount, I want you to come out of pocket to pay the difference. Right? Or sometimes you say, oh, I'm not paying the difference. If it doesn't appraise, I'm out of here. Now you got to start this process all over again with a whole nother house. You're wasting money because you already paid out of pocket for inspections, which can be $1,000. If you do a underground storage tank inspection, that's about $300. Then you want a home inspection, which is you actually hire somebody to look at all the electrical and systems. That could be several $100s. You could be out of pocket $1,000 a house, right? If you're gonna put money out there like that, make sure that you know what this house is worth before you go down that road. Make a fair, knowledgeable, informed offer. And then most importantly, be prepared to walk away. There'll always be another house. I used to think the same thing. Trust me, when we were trying to buy our first house, we were getting desperate. We was looking here, there, and everywhere. We just wanted a house so bad, and we lost all of them. The house we ended up buying, we got. I mean, we just got, we went, at the time we were young when we bought our first house. The woman actually paid for our closing costs. We got very lucky. So she was like, oh, we were able to roll our closing costs into the purchase price and get a seller's credit at the end. So we didn't really pay anything out of pocket, barely anything. And we got that house. And that's because the house was meant for us. That's my thing. God will create divine intervention for what's truly yours. So be prepared to walk away and don't be afraid to walk away. Another thing you need to know about the home buying process is do not sing to Jesus. Well, you can pray to Jesus every night that you keep the house. Say, Lord, please don't let them do me dirty in attorney review. But there's something called attorney review. So when you go into contract on a house, you sign saying that there's 3 days right to rescission, which means you can change your mind for 3 days and they can change their mind for 3 days. Those will be the longest, most stressful 3 days of your life, because at any point somebody else can come in and swoop that house right from underneath you, and they could say they don't need to give any reason for terminating the contract. They could just say, we're terminating it, and under attorney review, we're done. So for 3 days, pray. Okay, just pray. So your down payment with the lawyer. So whenever you do an offer on a house, you want to include what's called a good faith deposit. It could be $1,000, $500. It's basically letting the borrower know you're serious, you have money. You're going to write a check. You're going to send that check to the lawyer, and then your realtor will send a copy of all that information to the seller when you put your offer in. And then once everything starts going through, you're going to have to actually send your down payment over to the attorney so he could put it in escrow. So you basically will send a check, you can send a wire, and they hold that money in escrow. And there's certain conditions and terms that have to be made throughout the mortgage contract. So the mortgage contract has provisions. They have milestones, right? The first milestone is good faith deposit, which you don't have to give, but it's good to give one. The next step is a deposit. That has a date. Then it's mortgage commitment letter, which means you have to guarantee by this date, you will get a commitment letter from the bank saying we have underwrote this loan, we know the credit risk we're taking, and we have promised to give Amira a loan to buy your house. It's a letter that's called a commitment letter. You have to furnish that to the seller's attorney within a certain time frame. So know your contract. Know your contract details. Don't miss these deadlines. If you miss even one of these deadlines and you have a seller who has other buyers looking at their house and they know they can get more, they can use that as a reason to terminate the contract. They can say, oh, you violated this agreement, contract terminated, and now you lost the house. So you can't miss these deadlines. Do not, big no-no. There's deadlines around inspections. They may say, oh, you have 7 days after attorney review to do your home inspection. Don't miss that deadline. This includes all inspections: ground penetrating radar, home inspection, electrical inspection, plumbing inspection. Anything you want to do, you have a window to do it. And if you miss that window, you don't get to do the inspection. And you're still in the contract. So pay attention. Yeah, so those are the things you want to be sure of. Do anybody have any questions while I get to this point before I move on? Okay, so I'll answer these questions. Do FHA loan limits ever change? So the FHA typically allows you to borrow a loan up to $548,000. Anything over that is considered a jumbo mortgage, which has different terms and conditions. If I'll put the link to the FHA website in the description box, and I'll give you more information. Can I qualify for an FHA loan if I have a foreclosure? No. If you have a foreclosure and it's still on your credit report, I think you'll have a very difficult time getting any mortgage, FHA included. Can I apply a FHA loan without my spouse? No. If you are married, you are only allowed to have one FHA loan per family, like husband and wife. That's why a lot of people, before they get married, they buy their properties. Spouse A gets an FHA loan, buys a property. Spouse B gets an FHA loan, buys a property. Then they get married. Now y'all got two FHA loans, two properties acquired before the marriage. Now, and all you got to do to protect yourself is you sign off. They add you to the deed on their house. You add them to the deed on your house. Now it's mutually binding property. New Jersey is a community property state. But anything done before the marriage is obviously independent assets. But then you can get a prenup for that. See, I talk about prenups. So you can get prenup. All this could be worked out. Okay, so common mistakes people make when buying a house. Buying anything before your loan closes. That is the biggest no to no. Whatever your credit limits are, whatever it is, if you owe Capital One $49 when you apply for that loan, do not buy a single thing with Capital One. Again, keep it $49. Live off your debit card. You should think of borrowing when you're going through the mortgage underwriting process. Buying anything on credit, it should be like nails on a chalkboard. It should be like, no, don't do it. I don't care. You want to design your home. You want to go in Raymour and Flanigan and look at beautiful furniture. You like, oh, I'm about to get me a new Audi or Benz to pull up in my new house. No. Don't get no Walmart card. Don't get no Best Buy card, no Capital One, no bank cards, nothing. Freeze your credit. As a matter of fact, just pause. Just take all your credit cards. Don't even get tempted. Don't make a mistake. Take all your credit cards out of your wallet. Lock them in a safe in your home, put them in a drawer, lock the drawer, and go on about your life. The home buying process typically takes 30 to 45 days. If you can't survive without credit for 30 to 45 days, you don't need to be buying a house, period. So if you're the kind of person like, well, what I'm going to do, I need my credit cards. If you can't survive without credit for that long, you don't need to be buying no house. Let's go back to square one, pull your credit report and pay off some debt. So don't buy anything that will derail your whole mortgage. If you have more inquiries, some people like, I ain't buying nothing. I just wanted to know what my rate was going to be. No, they will deny your mortgage. You cannot have no more inquiries. You can't go anything. Some people say, I didn't buy the car. I just went to the Chevy because I wanted to see what my rate would be. I just wanted them to run my credit so I could know what my potential. No. Okay. Another thing you can't do is change jobs. Nope. Can't do that either. You locked and loaded for the next 45 days in your current employer. You can turn in your resignation letter 2 hours after your closing. You close. Matter of fact, don't even do that because you got to wait for the docs to get back to the office and get recorded. Don't even do that because don't even do that. You want to wait about 2 weeks just to be sure. Cover all your bases. Wait 2 weeks. If you want to resign from your job 2 weeks after you close on your house, do you, boo? They ain't going to do nothing they can do about it. But do not change jobs. Do not be like, oh, I got a better job making more money. I got this offer. I'm about to resign and go work here. No, they want to see stable employment. That is also very important in the underwriting process. If you've been with your job, they want to look at 10 years of employment history. And yes, they do verify employment. They will call and verify your salary. They will verify your employment. They will verify your bonuses. They will verify everything is verified to the T. Don't lie on your mortgage application about anything because you will not get away with it. Keep it 100%. So don't change jobs. Big no. Okay. And not understanding the terms and conditions of your contract, okay, and getting buyer's remorse. Once you sign a home contract, it is a legally binding, enforceable agreement. Period. Once you get out of attorney review, the only way out of a home is failing of inspection. It means there's something detrimental to the house, whether it's the furnace doesn't work, the AC don't work. Yes, these are valid reasons to terminate a contract. But after you pass that hurdle, the home inspection, the only way out is a mortgage decline letter. So if you don't really want the house, you can go ahead and go to Walmart and apply for a credit card. That'll tear your mortgage up in a second. So if you have buyer's remorse, this is more, you shouldn't do this. I'm saying this on you. Don't do this. I shouldn't tell you. That's illegal. But they got to prove it. Shh. Okay. So that's the only other way out is the mortgage declination letter. Okay. So inspections. What are included in the inspections? Number one, you want to look for underground storage tank. I talked about why that's important. If there's contaminated soil underneath the ground, you will have to pay for cleaning it up, and it could be very expensive. And that can prevent you from getting homeowners insurance, which you need on a house. You need homeowners insurance. If you have an underground storage tank, a lot of homeowners insurance companies will not insure your house. They don't want to take on that liability and that risk, because if the soil is contaminated and you have homeowners insurance, guess what? The homeowners insurance company has to pay for that contamination. They don't want to take on that undue risk, so they won't even take you on. And if they do take you on, your premium is probably going to be 2 times the amount of a normal person, like double, right? Like, why? So do an inspection to look for underground storage tanks. That you don't want to miss. Lead inspections, that it mean like if the paint is chipping and stuff like that. Houses built before a certain time probably were done with lead paint. Get a lead inspection, because lead is toxic. You don't want to be doing that. Asbestos. A lot of houses have asbestos floor tile. You know, them 9x9 tiles. You go into the basement. If you see it's 9x9, there's like an 85% chance it's asbestos. So be careful with that, because asbestos causes mesothelioma. Y'all saw the commercials. Have you or somebody you know have mesothelioma? You don't want mesothelioma. Asbestos is a very strong material, and if it's not broken or tampered with, asbestos is not dangerous. It's only dangerous when it becomes a free radical. I used to work at a company that did asbestos remediation and lead abatements, so I know a lot about asbestos. But if it breaks or something, it becomes free radicals, and that mess could kill you. I know someone who died from mesothelioma. Like, this is a real thing. Don't play about asbestos. People think it's a joke. It's not a joke. Don't mess around with asbestos. Sometimes asbestos is on the pipes. That's another thing you got to look for. So there's asbestos in its floor tile, and there could be asbestos wrapped pipes. It usually looks like insulation, but it's asbestos. So your home inspector will be able to point this out for you. You want that removed. And there's also another thing, knob and tube wiring for electrical. Burn your whole house down, okay? Knob and tube wiring, asbestos, mold. Oh my God. No mold. No. That you need a mold abatement. Mold abatements, a little small amount of mold. Whoo! It could run you 10 bands. Yes, 10 bands. You be careful with the mold too. Oh, thanks, Boo. You bought me some food. Thank you. Be careful with the mold. No mold, no asbestos, no underground storage tanks, no lead, a chimney sweep. Yes, so every house, well, not every house does have a chimney. I'm lying. Some of them just don't have a fireplace. So every house has a chimney. Depending on where the chimney is located, that is the structure that's holding your house together. It is like, it's bricks, but it creates like a foundational wall for your home. If your chimney has like missing bricks, or is broken, or has like a jig-jag break in it, you're going to need a new chimney, and that is something you don't want to be playing around with. If you have a fireplace, you want to get a chimney sweep. A chimney sweep basically goes into the inside of the chimney and makes sure that you know, you ain't going to light a fire one day and blow your house up. Plain and simple, that's what it does. These are things you don't want to overlook when you're buying a house. So if you have a fireplace, get a chimney sweep. Always have the home inspector look at your chimney. It'll be in your report. If he says the chimney's in bad condition, hire a chimney company, get an estimate for repairs. Asbestos, I say walk away. That's me on period. If you got asbestos wrapped pipes in your house, I don't even want the house, because you don't know it. You need negative air to get asbestos out. You got to you need a HEPA filter like that. That would keep me up at night wondering whether or not mesothelioma is lingering on my back door. I don't mess with asbestos pipes. If it's asbestos floor tile and it's intact, meaning it's those 9x9s, but they all in perfect condition, no problems, you can put a sealant over it. Like a sealant, you could seal this house. You put like a glazed coating, and then you can put flooring on top, or you can put carpet, or you can paint over top to seal in, and you know, you'll be okay. Asbestos floor tile ain't the worst thing. You could definitely be good with that, but the pipes, it ain't worth it. It ain't worth it. So be careful with that. And sometimes homeowners who know they're gonna sell, they'll just pull the asbestos piping off their self and throw it in the garbage bag, and then they'll put the house on the market. You won't even know it had asbestos piping. That's why this is the kind of stuff you want to get a home inspector who knows when the house was probably built, who can say, oh, this might have had asbestos tile here, or this might have had asbestos pipes. Like, you know what I mean? Like, get a knowledgeable home inspector. Get a knowledgeable home inspector. I'm a big believer in arm's length transactions. So if you get a realtor, a lot of times your realtor will tell you, oh, I know somebody who does home inspections, or I know somebody who do this, I know somebody who do that. I say no. I say, you my realtor, you my realtor. I'll find my own home inspector. You don't want these people knowing each other. You know why? Because they in cahoots. Like, they trying to get paid, trying to get each other paid. I don't like that. I keep everybody at arm's length. That way you make sure that everybody is working for you and they're not working for each other. Okay? Arm's length transactions only. Water leaks, obviously for obvious reasons. Plumbing is expensive. You want to look at the AC, the furnace, the electrical, and your plumbing. You also want to get a home warranty. I'm a big believer in home warranties. Practical, our AC unit went earlier this week. Yup, it just blew out. We bought our house and we knew it was an older unit. We got a home warranty. We always had a home warranty on every house we buy. We usually pay about $600 or $700 for the year. But if anything breaks, it covers Peach. So it covers plumbing, electrical, air conditioning, heating, and cooling. So at Peach, all of it's covered. You pay a $100 deductible. And if they cannot repair the appliance, they replace the appliance. So our AC unit, 3.5, whatever unit that probably costs, I don't know, a solid $12,000 to go buy a brand new one. It went, and you know what we paid out of pocket? $100 deductible, plus we paid about $1,000 because we had to pay for the non-covered parts. So there are some parts that are non-covered. I don't know the name of them. It was a little list, but that's $1,000. That's $1,100 versus paying $12,000. Okay, I am a big believer in home warranty. We've had our furnace go before, and they come out and they repair it. We've had a washing machine replaced. We've had our garbage disposal replaced. Like this is a no-brainer for me. Home warranty all day. We use American Home Shield. They're not sponsoring this video, but hey y'all, we like them a lot. We've also used another company in the past, and they were also really good. But I like American Home Shield better. They're quick. Like our AC unit broke on like Tuesday. By Thursday, we had a whole new AC. Like they sent the check immediately. So I like them. So shameless plug to them, but not so shameless because they earned it. Okay, so there's different ways that you can get repairs taken care of. So you can ask the seller to repair it themselves. You can say, I want you to fix it. I don't recommend this, but some people do. I say I ask for a seller credit if you want repairs. Why? Because you want to know the work was done according to your standards. This is going to be your home. You're going to be living there. You don't want them to go and fix something, you doing it bare minimum just to pass whatever, and it's not quality of what you would have wanted to do if you had the money to do yourself. So I usually will ask for a seller credit, but sometimes some people ask for the homeowners to do it themselves. Another thing I forgot to mention with FHA loans as a potential con, I think I might have skipped over it. So for FHA loans, there are certain things that have to be repaired, and that's why a lot of home sellers don't like it. So say, for example, if you're buying a house and you're getting an FHA loan and they come out and they do their independent inspection, because the FHA also sends out a person to do another inspection on the house themselves, but they're looking for like structural integrity problems. They're not necessarily looking for electrical. They're looking for like real issues. Let's say the house needs a new roof. The FHA program might say, yeah, you got to replace that roof. We had an FHA loan on our first house, and they wanted them to repaint the whole house. The whole exterior of the house needed to be repainted because it was cedar siding and it had started to chip. And that could be, that's like integrity, property integrity. So they went to her and it was like, well, you got to repaint the whole house. We came to an agreement. We paid for half of it. She paid for the other half. And we got it done. It wasn't even that big of a deal. They painted it. The guy came back out, looked at the house, said it was good to go, and we closed. So it's not the end of the world, but that is something that could come up. So when you're at the closing, we're getting toward the end. Yay. So when you're at the closing, here's some things you want to be mindful of. You want to confirm your interest rate. That's number one. If you don't read nothing else in them closing docs, the lawyer going to be talking to you a whole bunch. Everybody's ready to celebrate. The lawyer getting his check. Your realtor's getting him or her check. They ready to go party and do shots. They're going to give you a beautiful basket. Oh, congratulations on your home, for everything. I mean, it's going to be a great day. But do not let that distract you from the fact that you need to read your loan agreement, right? You want to read your if you don't read nothing else, you want to read your closing, your HUD statement, and your loan agreement to know your interest rate. Confirm it's what you thought it was going to be. You want to make sure they didn't add no points to your interest rate, and you want to read your HUD statement to make sure that everything that's on your closing statement, if you have a FHA loan, there'll be a HUD statement. You want to say, is everything here? Is my attorney fee right? Is my realtor fee correct? Is my out of pocket correct? And my seller credits, are they listed? Am I getting my check? Did I send the right amount? Did they give me the right amount? Make sure that it balances out and everything's copacetic, because that you want to make sure you're getting what you paid for. So that goes to confirming fees, and you're gonna have to send a wire to your lawyer for the closing costs. That wire is usually sent the morning of the closing. You wire them the remaining amount before you get to your loan closing. And you want to make sure you get your credits from the seller, but you want to get the check from your attorney. So the attorney has like they send the money, the seller would send if they owe you money. So if the seller owes you $1,000 at closing because they want to repaint the living room, right? Or I don't know, whatever. The seller would wire that money to your attorney into an escrow account, and then your attorney will write you a check from that IOTA account for it, which means it's a guaranteed check. You don't want to be getting a check from the seller on the side. Now they put a stop payment on it. You own the house, and now they got a stop payment on the check, and you can't fix your floor because now you don't know where the seller went. They done ran off the Timbuktu, and now you got to get your lawyer involved to try to sue them. And who wants the drama? Get a wire and get your check from the attorney directly. Is that the end? Yes, that's the end. So anybody have any questions? I know this was a long thing. I have a consult in 9 minutes, but I got to get ready to go soon. But anybody have any questions before I go? Any feedback about the presentation, any questions? Obviously, the live is going to be saved. So if you want to watch it later in pieces, it'll be here for you to watch. And yeah, so I'll give it a couple of seconds because I know there's a delay. I think my son got me sick. Oh, this was amazing. Oh, thank you, Kendall. I appreciate it. Look, tell a friend to come subscribe to my channel and watch this video. I'm going to be doing more videos like this. I know I said a while ago I was going to be moving around the content on my channel. I do want to do that, but there's been a lot going on in my life in the last 30 days, a whole lot of crazy. So I haven't been able to really zoom in, but I had this particular presentation planned, and I wanted to make sure that I got it out. But my next one, I definitely want to go into more detail about different financial topics like this that can be helpful to the community. So I'll be doing a lot more of this on my channel. And then when I'm on my walks, obviously I do my advice and like my chit chats. But my son, I think he has officially gotten me sick. You hear me? I'm getting sick as I'm sitting here. Like I'm sitting here and I feel the germs. Like it started right here, and then it was like right here. Then it was right here. Then it was right here. Then I started choking, and then you saw me drink some water, and then it went here. Now it's right here. Like he just got me sick as a dog because he's been laying on top of me. I'm about to digress. Y'all need to. Strangers are gonna be watching this. I'm talking to y'all like y'all my people. Y'all are my people. But thank you, Audrey. Y'all are my people. But I'll get in another live, and I'll later on, maybe tonight or tomorrow, and I'll talk to you guys about what's going on in my life. Because this is a professional one, and I don't want strangers knowing everything. As if I care, but still, it's not for this. Okay, this was amazing from my experience. This information was very helpful for future homeowners. Thank you so much, Mom of Three. I appreciate you joining. I truly appreciate the support, guys. I love helping people any way that I can. If you're working and you're worried about your debt to income ratio, you could pay some debt down, but you could also call me. I redo resumes. I ice you out. Increase your salary $20,000, $30,000. I'm doing it, proven testimonies on my Instagram page. You should see, even on my YouTube, people comment. I like put in my story, I'll put like some feedback and stuff like that. People are getting paid out here in these streets. Okay. So if you want to increase your income and you don't have to pay, you want to pay your debt off, hit me up. It's gltcareer.com. That's gltcareer.com. And you can book my services to do your resume. Okay. I got 6 minutes. Gotta go. Does it make sense to rent or own these days? Oh, in this current environment, rents are going up and so are home prices. Rates are very low. I think if you could find a good deal on a house and you can get 3% interest rate and you put very little down and get your first house, I say buy a house. ultimately houses will appreciate over time. It's the time value of money. We could talk about that on another live, but the time value of money, you can never go wrong investing in real estate if your intention is to hold it for the long term investment strategy. Can't miss out. Short-term investment strategy, if you know you're the kind of person who's going to move in 2 years, don't buy a house right now. Rent, because housing prices are unbelievably inflated, and I don't want to see anybody get hurt. But yeah, all right, I got to jump on a consult for a resume. So thank you so much, you guys, for stopping into my live. I appreciate it. If you have any questions or think of anything after this, please drop a comment down below. I'll leave the links in the description box. Give me like about an hour to do so because I got to run. But I will do so. You can always DM me on @girlletstalk.com, @girllets_talk on Instagram, and you can DM me and I will answer any questions that you have that we didn't get to cover. Thanks, babe. You guys are so sweet. All right, bye.